So risk management, a lot of people talk about it. And if you watch the shows or if you're on X and you follow traders, they say, I take this trade, but follow proper risk management. Well, what the hell does that even mean? So if you're wondering, this show is for you. I'm going to boil it down and make it completely understandable. And also it will help you become a better and more profitable and more calculated trader overall. If you don't know who I am, my name is Fefe. Been in the space since 2016. Made it all, lost it all, made it all. This is my third bull market. I'm a professional trader and I dedicated my life on helping you guys navigate the bull market and crypto in general. If that sounds good, make sure to subscribe to the channel. Make sure to follow me on X. There is a link in the description to my X profile. I share with you my charts, my thoughts, my analysis, and much more. And without further ado, let's jump into it. So a lot of people talk about risk management, but I see not a lot of people really understand what risk management really is. And yesterday I put up a show on Crypto Banter here, which was about journaling and the importance of actually journaling your trades. And I said that there are two main ways you can actually become a profitable trader, or two main steps you need to make complete to become a profitable trader. And one is to battle yourself and win you against you. So you have to understand what the patterns that you're carrying through and what behavior you have that blocks you in becoming a profitable trader. And then two is that you have to have a strategy and a proper risk management. Now, a strategy is quite simple because you have millions and millions and millions of strategies on YouTube and on TikTok and wherever. A strategy can be MACD cross or RSI or whatever you want to use. I don't use those because they don't work, but in general, you find a strategy, you backtest the strategy. If the strategy works, that is a good strategy for you. Then you only need to find out what is the behavior pattern that you have so that you can overcome that. That's what yesterday's show was about. And then you have to have proper risk management. What does that really mean? So risk management in general, in my book, means that you are able to manage your downside while you're preparing to gain on the upside. And what a lot of people don't understand is, a lot of people say, what leverage did you use? Do you 10x leverage? Leverage doesn't matter. What matters is what is your risk? How much money, in other words, are you risking on this trade? So when you have, and I have this lined up here. I have this little drawing board here that I will use to draw stuff. So if you have a trade, right? This is how the chart goes, and you want to get in on an entry. Let's say this is your entry. You have to identify what will be your stop loss levels and what will be your take profit levels. Once you identify these, most people know when they want to take profits and when they're going to take their stop loss based on their strategy. The question really is that from your entry, which is here, if the chart goes against you, how much money will you lose? And when it really comes to risk management, what people really misunderstand is that trading is just like running a casino. The casino always wins because it is calculated. It follows certain procedures and follows its plan, or in other words, you can say you follow your trading plan, and you know that eventually you are going to be profitable at the end of the day. That means if the casino loses $1 million a day, they don't care, because they understand that there are days, which we call in trading drawdowns, or you can call them drawdowns in the casino world as well, where that is going to be negative, because that's just the probabilities. Maybe there will be an idiot coming in completely drunk and throws the ball or whatever, pulls the machine or plays poker and makes $1 million. Fine. The casino knows that it will lose on certain days. A lot of days, it will actually be negative. But on an overall picture, it will make a shit ton of money. And that's the same with trading. You understand that you have to understand that trading is a game of probabilities. So when you look at this and when you say, okay, so if my trade goes against me, and this is the most important question in risk management, if my trade goes against me, I think this is a great trade because of whatever strategy I follow. If this trade goes against me, how much money will I lose off my account? That's basically the most important question you have to ask on each trade. Not about how much. A lot of people focus on, oh my God, I'm sitting in my Ferrari. If this trade goes well, I'm gonna be, a millionaire. But if this goes bad, then I'm gonna, I'm just gonna get myself wrecked. But a lot of people don't think about the part where they wreck themselves. So how much money am I going to lose if this trade goes against me? If your account, let's say, is $1,000, and this is where proper risk management kicks in. Let's say you have an account of $1,000. How much money will you lose if your stop loss gets here? Now, most of the exchanges, all of the exchanges, when you set your stop loss, you will be able to see how much cash you're going to lose. Let's say I set my stop loss down here. I'm going to lose $100. That means on this one trade, you're going to lose 10% of your account if the chart goes against you. And again, I want you to remember that trading is a game of probabilities. Therefore, no one knows the outcome. We play on our edge and we believe that something is going to happen and we believe that this is the right outcome based on the previous experiences, but no one really knows. There can be news, there can be Trump saying anything. No one knows what is really going to happen. So it's very important to always think about your downside. So when you think about your downside, 10% is a lot. Here's how you build up a proper risk management plan. When you, and I'm going to bring you another analogy, when you play poker, you have to sit in with at least enough money to bear 100 blinds. So blinds are the money that you put in, whether you're playing or you don't play. You have small blinds, big blinds, but you have to pay a certain amount of money to see your cards, right? And so if you don't have enough runway for you to see enough cards, the numbers are basically stacked against you because, again, it's a game of probabilities, just like trading. So if you don't have enough money to wait out the right trades, you are going to get yourself wrecked. And the only way to wait out the good trades is to risk very little on each individual trade. I want you to do one thing before we even go into the step by step. Rewire your brain to the long run. The most money is lost because people want to make a fortune overnight. That's the reality. You come into crypto, you hear your friend making 2x, 3x, 5x. People, especially in crypto, they're like, I made it 200%. Like it's nothing, bro. 200% is 10 years on the S&P, 15 years on the S&P. It's crazy money, crazy money. And people have different expectations and high expectations that doesn't make any sense and will eventually get them wrecked. So I want you to rewire your brain and rewire it so that you are thinking long term. It's not about that one trade. It's not about that 1 week. It's not about that 1 month. It's about the next 2,000 trades. It's about the next 5,000 trades. And I know that these are big numbers, but if you want to make it all in 10 trades, or if you come to the trading board and say, hey, I want to make $200 in the next 2 hours and I have $1,000, that will result in you taking massive amount of risks, not worrying about your downside and getting yourself wrecked. So rewire your brain and start thinking about 50 trades, 100 trades at once, and then reevaluate from there. Now, if you understand the fact that that trading is a game of probabilities, and you have a strategy, from that you can see what the probability of that outcome is. What do I mean by that? What I mean is the following. If you see here, let's say that I have a strategy that says every time, I don't know, you probably use MACD. I don't use MACD, but every time the MACD crosses whatever like this, then I have a winning entry and I can enter. Now, 5 out of 10 times when this happens, or 50 out of 100 times, the probability is the 50-50%, this happens. But, and here's the big but, every time this happens, I win $200. I'm just going to make it simple for an example. I put in $1,000, right? So every time this happens, if it's a win, I make $200. If it's a loss, I only lose $100. Pay attention here. This is the important part. It's 50-50. The probability of it happening is 50-50. Means out of 100 trades, 50 times I know for a fact, statistically, that I am going to lose. Because this is just the math. I know I'm going to lose. And then another 50%, I know I'm going to win. And every time I win $200. And every time I lose only $100. What does that leave me with? That leaves me with the fact that even though that the probability of an outcome for a trade is 50-50, I will make much more money. I will double my money basically, even though I'm going to lose 50% of the time. So going back to this, very, very, very important. Just so, again, we are clear. You have a strategy. 1, you have a strategy. Okay? 2, you understand the probability of that strategy. You can also call it hit rate or win rate or whatever you want to call it, okay? Hit rate, win rate. You understand what the probability of that trade, the outcome of that trade is. And once you understand this, you can calculate your risk management. So let's say, again, sticking with this example, I have, let's take a 10 badge because probably you're not going to start with 100 trades. Let's take a 10 badge. So I'm going to go with 5 out of 10 trades is going to be winner. out of 10 trades is going to be winner, and 5 out of 10 trades is going to be a loser. Great. When I win $200 each. That means that I'm going to win $1,000 here. Okay? When I lose, I'm only losing $100. That means that 5 to 100, right? 5 times 100, I'm going to lose $500. This will leave me with a net profit of $500. Okay? It's very simple. Simple math. If this was a little bit complicated, get back to it, rewatch the video, and take notes. But once you understand, again, we start from the strategy. You understand your strategy. You know, if the MACD crosses whatever I buy. Then you go back and you say, what is the probability of that outcome? I look back the past 15 times, 20 times, 100 times. And I say, every time this happened, I could have made $200 because this is what the chart would have given me, a 20% pump, for example, here, if I just look at $1,000. And every time I would have lost, I would have just lost $100 because that's my strategy. I'm going to jump into the charts in a second and show you. And once you have this, you understand that every time I risk this, I risk $100. And here is the next step. Here's the very, very, very important step that is really going to define your risk management, okay? Every time you lose $100. Okay, so we understand again that every time we lose, that's $100. Bear with me here. So if it's 50-50 probability, right? Because that's what we see here. It's 50-50 probability. That means that this is 50-50 on a larger scale as well. So if it's 5 out of 10 equals 50 out of 100, and also equals 500 out of 1,000. Why is this relevant? And this is what a lot of people screw up, is that when it is 5 out of 10, it's fine because I risk $100, 10 trades. That means worst case scenario, I'm going to lose $500, and then I'm going to make $1,000 because the first 5 trades is going to be a loser, no problem, because the next 5 trades is going to be a winner, and I'm going to make $1,000. Well, that's not how it works because of this and because of this. Because it can happen, and this is what a trader calls a drawdown, is that no matter how good your strategy is, there can be uncertain events that you can't see. There can be market changes that you can't see that will result in 50 losses or 40 losses or 30 losses straight out. Now, if you have, I'm just giving this an example, right? If you have $1,000 total, $1,000 total, and you are losing 100 per trade because you count on the fact that it's 50-50, 10 trades, I'm going to make, I'm going to lose the same math here. I'm going to lose 500 fine because I'm going to make 1,000. I'm going to be $500 profit and I move on. That's a problem because what can happen is that this will leave you 10 trades total to get liquidated because 10 times 100, it's 1,000. You have 10 trades to actually make it happen. And if you are not, and your strategy can be the best in the world. It can be profitable. It can be great. It's not about, did I get the strategy right or wrong? Because that's another video for another topic. And this is why I want to tell you, subscribe to the channel. I bring you alpha like this. If you like this and appreciate it, please smash the like button and also make sure to follow me on X. There is a link in the description. I give you alpha like this and much more. So go and check that out. But so this, you will have 10 trades to do this, okay? So what you really want to understand in risk management is you have to have, and this is going back to the poker example, you have to have at least 100 trades to take. At least. What does this mean in the example of $1,000 account? That means I have to create, you remember what we said first? First said, what is my stop loss here? What is my stop loss and what is my take profit? Well, the way to define that, and this is how the whole thing is going to come together, is that you got to have 100 trades enough. So you should be able to take 100 trades with your account. Now, that means you can't risk losing $100. You can only risk losing $10 on each trade. Why? 10 times 100, it's 1,000. So once you understand this and everything I explained based on the probabilities, you understand that you need at least 100 trades runway for you to be able to sustain the drawdowns that might and most likely will happen at some point. Once you understand that you need at least 100, but rather 200, 300, whatever, obviously more money you have, the bigger capital you can play with, the more you can push this out. But once you understand that you have to have at least 100 trades running, you understand what the risk can be on each trade. You have a $1,000 account here. You have 100 trades running, you have $10. $2,000 account, 100 trades running, $20. $10,000 account, 100 trades running, $100. That's a stop loss. Every time you take a stop loss, that cannot be more than $10 in this example. So once you understand that the question really is, how do I calculate? If you understand this whole thing, you will understand that leverage doesn't matter. It doesn't matter because leverage is just a tool that you can use to multiply your cash. So I have a full show. We're going to put it up here. I have a full show on what leverage really is. And then you can look that up. But you have to understand leverage. The tool, I have $1,000 and that allows me to borrow on 10x, take $10,000 purchasing power, right? And then I can trade with this $10,000. How people get wrecked is that you take a $10,000 account and now your risk on 1% drop, your risk is $100, even though you know that your risk should not be more than 10. So even though you follow all principles and understand it, you take a 10x leverage position based on the same principles that you've done and you're screwed because of this, okay? So what does this whole thing leave me with is the following. When you are getting onto the chart, I'm getting back here again. You have an entry here, right? This is your entry. So if you have an entry here, you have to calculate this percentage-wise. Let's say this is, I'm just going to give you an example. It's 10%. 10% on the chart. And then you know every time, again, your strategy told you that every time you get into a position based on your strategy, you can make $200. So therefore, it's 10% drop here on 1,000. And let's say it's up here. This is the potential profit target, which is 20%. So this way you have something called the risk reward, okay? This is the risk, this is the reward. Reward, risk. This is what you see a lot of times when people draft this 2-to-1 risk reward, for example, or 3-to-1. Actually, it depends on how you look at it because it can go 1-to-2, 1-to-3, depending on how is it reward to risk reward. But if you look at risk to reward, you're risking 1 to gain 2. If you're risking 1 to gain 3, risking 1 to gain 5. Higher the risk reward is, the better for you, because if your strategy says that you have a very high risk reward trade, that means that for every loss you're going to make, let's say at 1 to 5, for every one loss, you're going to make 5 wins back. For every $10 loss, in the case we had previously, you're going to make $50 back. So if you understand this, you know that you have to make sure to protect this. This is the key here. It's not about how much money I'm going to make on this trade, which is important, but it comes from the strategy and is given. How can I limit my losses here so that it fits into my risk management? So if I have this, I'm going to jump back in the charts here. But once I have this, here's what you need to know. Once you have the number that you can pull in here, and you can once you have the number, let's say it's a 10% drop on the chart, and once you have your max risk tolerance based on your account, remember what we did here. If you have a $1,000 account, you can only risk $10 because you need a $100 trade running. You can start playing with the market. Here is the summary. 1, you have risk tolerance. Sorry about this. As dollar value, $10 per trade, right? Let's say trade. This comes from your account. If you don't understand, please look back or ask me in the comments. Risk tolerance, $10 per trade. Then you have to have your account size. You already calculated that. This is basically what you need. Risk tolerance, and then of course you need the RR. The risk reward comes from your strategy. Okay, it comes from your strategy. So that's basically what you need. Now, how do I proceed onto the chart? Let me show you. So when you understand all that, you know how much I can risk. I can risk $10, and then I know what my risk reward is. So let's say I want to let's not argue about the chart and is it good, is it bad, or whatever. Let's say that I'm taking a long position here on Sol, okay, for any reason. My strategy says I take a long position. My strategy says that the low is in here. Let's say it's here. I want to just make it easier a little bit so it fits like 5%. It's a risk reward tool, by the way. If you don't know what this is, you just simply go on to TradingView. There's a link in the description too. I appreciate if you use my link if you don't have the premium. But you go here, you click on here, and then you get the risk reward tool. You go long position or short position, and basically shows you here as you see. And I said that we're going to win 2. So if it's a 5% drawdown, it has to be a 15%. No, it's 10%. Pump. So you see here, the risk reward ratio is 2. So I'm risking 1, which is down here. This is the 1. And I'm winning 2 if the trade works out as it should work out. So if you see this and you say, I want to go short here, here's what a lot of people do. I'm just going to take a 10x leverage position with like maybe 25% of my account. And I don't think it through as I'm going to teach you how you should. And it sounds complicated, but I promise you, by time, it really comes to you. Like it really comes to you and it's becoming easy. So if the chart here says 5%, do you see this down here? It says 5% down here. You see, this means that this drop, if the chart would go to my stop loss, this would be a 5% drop on the chart. Now that means if I don't take any leverage, I just use my spot account. And I have, again, remember, I have $1,000, right? I have $1,000. I use my $1,000 account and I put the whole money in. That means I will lose $50 because this is how much I would lose, because I can lose $10. That is the 1% of what we agreed. You remember in the previous example. But in this case, if I put my whole account in, I will lose $50. That means I cannot put my whole account into this trade because I'm gonna lose more, 5 times more in fact, than what I could based on my risk management plan. So what I do here is I start going down, and then you can start dividing it as well. But if you go like, okay, what if I put in $500? Well, if I put in $500 and it drops 5% down here, how much is that? It's 25, eh? So that's $25. Okay, so then I'm gonna go down again, and I'm gonna go like, okay, so that means that if I put in $250, then it's gonna be $12. And then you come to the realization that you should probably put in about $220 into this trade to lose $10 on your account, right? You gotta put in if it's 5%, you could put in $200 to lose 10%. Why? 5% of the $200 is $10. And you know from your risk management plan that you can only lose $10 per trade. So, and this is where it becomes interesting, because what happens if you want to play bigger? What happens if you have some cash on the side, you just don't want to put it in the market, but you say that can also be my trading account, then you can start using leverage and leverage up. But leverage I would only advise you to do leverage if you have small risk. Let's say you're scalping. Let me show you another example here. I hope that makes sense. Again, guys, I'm going to be here in the comments, and I reply to most of the comments I try to reply to on my X, and I'm probably going to do some seminars like this. So it's worth following me on X. But let me jump in here. Let's say you're scalping, right? I'm just giving you an example here. And you're a scalper, you go down onto the 3-minute chart, the 1-minute chart, whatever you might want to do. And you go, okay, so let's say I have my risk reward tool here. This is my trade, and my stop loss is like here because my strategy says so, okay? Let's say it's 0.1%. Why not? Let's say 0.1%. This small. Down here. You see it says 0.1%. And then I can put it here. This is my strategy because I'm such a G, for whatever reason, okay? So you look here, this is my risk, 0.1%. So if I have $1,000 account, if I have 0.1% loss on the chart, as you see here, that means if I put my whole account in, I'm gonna lose $1. But it's not like, oh, sure, I'm not gonna lose 10, so it's all fine. No, because if I don't put in the $10 on my risk, if I don't risk $10, my reward, remember, my strategy told me that it's always 1 to 2 or 1 to 3. It's always going to be changing. So if I put in $1 as risk, I'm only going to gain $2, which goes completely against my risk management. So what do I have to do? I have to leverage up. This is where leverage is really useful, because I can say, okay, I'm going to take a 10x leverage position. That will make my account $10,000. And this move on the chart, which is 0.10%, will be 10x as well. And therefore, that will be 1%. And therefore, I'm going to go up to the $10. This is basically how the whole thing works. This is how you can use proper risk management. Now, I know it's a bunch of information. I know. But I try to keep this video short and to the point. What I really want you to do is look back on everything, ask questions in the comments below, come to my X because I'm going to start posting more of these. I do have a trading channel. It's called the 100X Club, which is designed to give you these trading alphas. So I'm going to start posting here. There's a link in the description. So it's going to be all this type of content. And I just want to make sure that you understand the whole concept and you do not get wrecked. As a very short summary, one, you have to have a strategy with a great understanding of the probability of the outcome of those trades. You have to understand how much money you're willing to risk on a trade from calculating your account size and then just dividing it by at least 100. Then when you understood how much money you can risk, you want to make sure that you put your risk reward tool on the chart and understand every single time what your risk on that specific trade is and adopt your leverage or your position size based on what the percent loss on the chart would be based on your strategy. And once you have that, you have a proper risk management plan. Now, obviously, I could talk hours and hours and hours. This is why I'm going to come to you with more content throughout different platforms. Make sure that you subscribe here to the channel. Make sure you follow me on X. Make sure you subscribe to the 100 Club for more trading alpha. I truly appreciate you. Thanks for bearing through. And I congratulate you because I know it was heavy. But I think it will give you a stepping stone in your trading. And I'm pretty confident that by simply implementing some of the stuff that we talked about here today will help you immensely. So guys, thank you so much for watching. You can check these two videos out. If you like them, let me know as well. I don't know what they are, but they're probably pretty cool. And you can click here to subscribe to the channel. Thank you so much for watching. I truly appreciate you. And I believe I'll see you in the next one. Take care.